There was a study that reviewed businesses that last longer than 2 years but close within 5 years. They found that 65% of those businesses that close within 5 years close due to cash flow problems. So, cash flow is the lifeblood of the company and it's so important. Okay. Now, what actually is cash flow? Cash flow is the money that's flowing into the company and stays in the company. Okay, it's not revenue. Revenue flows in and then goes out in costs and expenses and draws and things like that. Cash flow is what comes into the company and stays after costs and expense and dividends and note payments and all those things. Whatever money stays is cash flow. And and the whole and the whole purpose of a business is to generate cash flow. And so when I hear that 65% of businesses close after a period of time due to cash flow, that tells me that there's an issue. That tells me that there's a systemic cash flow problem in small businesses across the United States. And so we're here to fix it. All right, so how do we fix cash flow? The first thing we can do to fix cash flow is to build a budget. And a budget helps us do three things. It helps us assess operational risks. It helps us plan for cash flow items like trucks and equipment and things that we need to purchase. And number three, it helps us detect problems ahead of time so that we can fix them before they become a true problem. So let's talk about how budgeting helps us assess operational risk. In a moving company, you guys know that in the spring, we're starting to ramp up, right? We're having more sales, we're needing more people, we're needing more trucks, we're needing more costs to generate more revenue. And on the back end, in the fall and the winter, that revenue starts to decline. And now we have these dropping in costs, dropping in expenses, but also dropping in revenue. So what a budget allows us to do is plan ahead to understand what are those costs going to be at what part of the year and how much cash am I going to need to make sure that I'm not running too negative, that I'm going to burn through all of my cash. Okay. So in assessing risk, a budget allows us to understand how much cash we need to make sure that if we do hit these certain revenue and cost budget areas, that we're not going to be bled dry before that actually comes to fruition. Okay. One of the biggest issues I see in a lot of moving companies is in the spring, they've used all their cash flow through the winter. Now the spring comes, they're looking to ramp up with new people. They're looking to ramp up with new trucks. They would like to buy trucks, but their cash is gone. And so what that does is delays that growth. When you delay the growth, you delay the cash flow, and that becomes a perpetual cycle of not being able to grow because the cash flow is bled all through the winter, and now there's not enough money to grow more, to bring in more cash flow, to grow more, to bring in more cash flow. So a budget allows us to assess risk, to understand what parts of the company at what parts of the year have the highest risk of cash flow degradation, and how can we funnel cash and funnel operational efficiencies to those areas to make sure that we're efficient and we're using our money in a wise way. Number two is it allows us to plan for staffing and trucks and things like that. Again, we're ramping up in the spring. How many people are we going to use? How many FTEs? We call it FTEs, full-time equivalent. How many full-time equivalent people are we going to need in the spring if we're going to be hitting these certain revenue budgets, right? Revenue is generated from pounds in the moving industry, right? Pounds translate to number of people. So how many people do we need to plan for? How many people do we need to hire so that when we're going into the spring, we can hit the revenue targets that we want to hit and hit the goals that we want to hit? Okay, so it allows us to plan for how many people and how many trucks and how much equipment do we need so that we can hit our goals in the spring and throughout the year. And then finally, it allows us to detect problems. So we look at something called a BVA, a budget versus actual, every month because we want to understand what did we plan for, the budget, and what actually happened, the actual, right? We compare our budget versus our actual. And we can really quickly, easy identify the things that are different than what we planned for. And if they were different, either one, there's a reason and we're seeking to grow. And so we realize that we spent more than our budget because it's in the pursuit of growth. Or two, we have costs that we didn't plan for that are coming out of our account that's eating into our cash flow. That's what we need to fix. Okay, so a budget versus actual review every month allows us to look at what's going right and be happy or improve it more, and look at what's wrong and cut it out or improve it further. And on the back end of that, what I'll say is the biggest issue that I see in so many moving companies as it relates to cash flow is planning for over expansion. Okay. Over expansion is very, very costly. And while expansion is great, Overexpansion for whatever your cash flow allows will kill your company. So it's really important when you're budgeting that you're budgeting appropriately, you're being honest with yourself, you're looking at how much cash you're going to need and how much cash you have on hand, and do not grow and do not plan to grow, do not throw money at marketing until you have that cash to be able to do so and lose if it doesn't work out, or be able to fund if it does. Okay, there's two big things with marketing that has an impact. Either it's really, really good or it's really, really bad. And if it's really, really good, you have to have enough cash to be able to afford it or afford the growth. And if it's really, really bad, you have to have enough cash that you're burning it and you're still okay. Okay, either way, we got to have cash. We got to have cash flow to make sure that whatever we're doing, we can continue to sustain operations and we can grow in a really efficient way. And a lot of that stems from the budget and then naturally the effects of cash flow.